These minutes, oil's down a lot, GDP expectations are off a lot, credit spreads are wider, treasury yields are down. We basically said the market's kind of calling the bluff. S&P's 5 or 6% up off the lows. You've had afternoon rallies each of the past 3 days. The hardest hit parts of the market are actually holding above their lows, and you finally got a shakeout in oil and energy. So the last bastion of the overconfidence in this market has basically been undercut. Tell me why this is not perhaps the makings of something better on the upside.
I want it to be so badly, Michael. And as you and I talked about the last time we were on together on this show, you have to be open-minded now. So I'm willing to get to a point where I say, look, nothing technically has changed. We've enjoyed a rally in a bear market, and that's great. And we've had a bunch, and they've all led to lower lows. And this one is still guilty until being proven innocent. But we are doing a lot of the work. Like when June ended and everyone on Wall Street did their worst first half ever, and the guy from Deutsche Bank did the 10-year treasuries, worst first 6 months to a year since 1788. I don't know what his data source is. But like when those notes went out, like the thing that we looked at
too, yeah.
Right. The thing that we did was we looked at each other and we said, you know, this is the worst start to a year for 60-40 portfolio in decades, for straight up stocks, for any kind of stock you want to come up with, for stock bond mix, 60-40, 70-30, international. Like, we're living through that now. That doesn't repeat. Like, that's not, you're not going to have a second half that's as bad or worse because one of these asset classes has to win out. So in the early going, it looks like it's going to be fixed income. So now you're getting decent yields. Barron's did its cover story over the weekend. Now there's actually yield in like 7 or 8 different places. That's a new competitive threat, I would say, for the stock market because people still have money to put to work and they still have to choose. So that's why, look at today, consumer staples and utilities leading and defense stocks, which never gives you the warm and fuzzy. Not defensive, but like literally bombs and guns. So if that's what's going on, healthcare looked pretty good today too. If that's what's going on right now, just accept it. Try to be there also. You don't need a full market rally. We just need days like today to take some of the pressure off. Yeah,
and honestly, you know, the average stock was not really doing much of anything today. The big caps did carry the indexes higher. More stocks down than up. Equal weight, you know, is kind of blah. So granted, you don't want to make too much of any one day or a string of days. And frankly, I wasn't necessarily saying we need to declare a low is here and somehow I've been persuaded with this market. But it's interesting because like last week you were on here saying price is truth. It's a downtrend. Don't fight the Fed. This market has told you not to trust rallies. And then I saw you yesterday on halftime, and it was about the, you know, look, asset allocation maybe benefits from mean reversion here. Things don't stay terrible for long. It's like those are the two wolves fighting in your heart. Now, which one are you going to feed the most right now? Either the sell the rallies hard or the, you know, maybe think about what might be right, go right and have some upside risk to it.